Somewhere inside a government filing system right now, there is a form with your name on it. And a single checkbox on that form is costing you up to $400 every month without your knowledge and without your permission. You signed it years ago. You selected an option you barely understood. You handed it over and assumed the system would do the rest. It did not. The Social Security Administration filed your instruction and has been executing it robotically every single month since that day, never checking whether it still makes sense, never comparing it to your actual tax liability, never alerting you that the amount being pulled from your check has no connection to what you truly owe. For millions of retirees across America, this is not a hypothetical. It is an ongoing, compounding loss of $200, $300, or more than $400 every month that accumulates into tens of thousands of dollars over the course of a retirement, not because of any new legislation, not because of a policy change, because of a stale instruction on a form that was designed to be updated, but that almost no one ever updates, because almost no one ever explains that updating it is necessary and entirely within your control. What you are about to learn could put real money back into your monthly deposit starting within 60 days, and the entire correction requires nothing more than a single page and a single stamp. The form at the center of this problem is the W-4V, and the checkbox controls how much federal income tax is withheld from your Social Security benefit each month. When you first began collecting benefits, you completed this form and selected a withholding percentage from a short list of options. The available rates are 7%, 10%, 12%, or 22% of your gross monthly benefit. No custom amounts, no sliding adjustments, no annual recalculations. Whatever rate you selected became a permanent standing order that the Social Security Administration applies to every payment it sends you, indefinitely, without variation, without review, and without any mechanism that would flag a mismatch between what is being withheld and what you actually owe at the end of the year. During your working years, your employer recalculated withholding whenever your income changed, or you submitted a new W-4. The Social Security Administration performs no comparable function. It is not a payroll department. It is a payment processor executing your original instruction on autopilot until the day you physically submit a replacement form telling it to do something different. This creates an expensive problem for two distinct groups of retirees, and both groups typically believe the problem does not apply to them. The first group is the senior who sees a withholding line on their Social Security statement and assumes the amount must be correct because a government agency is processing it. That assumption may be the single most expensive belief in retirement. The Social Security Administration did not calculate your withholding based on your tax return. You selected a flat percentage years ago when your income, your deductions, your filing status, and your overall tax picture may have looked completely different from what they look like today. Perhaps you were still working part-time. Perhaps your spouse was alive and contributing household income that no longer exists. Perhaps you had investment gains or pension payments that have since stopped. None of those changes triggered any update to your withholding because the system does not track your tax situation. It executes your instruction. Period. The second group is the senior, who chose zero withholding and believes they are keeping their entire benefit. Their check arrives each month without deductions, which feels like the full amount. But no withholding does not mean no tax obligation. If total income from all sources pushes provisional income above established thresholds, federal tax is owed on up to 85% of their Social Security benefit, regardless of whether a single dollar was withheld. These retirees are not keeping their full benefit. They are building an invisible bill that materializes every April, frequently accompanied by underpayment penalties and interest that make an already unpleasant surprise even more costly. The reason no one warns either group is structural. The Social Security Administration and the Internal Revenue Service are separate federal agencies with separate mandates and separate databases. The Social Security Administration delivers your benefit and processes your withholding election. The IRS collects your return and determines what you owed. Neither agency has a responsibility to compare those two numbers and alert you when they diverge. Neither agency will contact you to say your withholding has been excessive for a decade. Neither agency will suggest you file a new form. The gap between what is withheld and what is owed simply persists, month after month, until you discover it yourself and take action. For the over-withholding group, that gap manifests as an annual refund they celebrate without realizing it represents their own money returned a year late with no interest. For the under-withholding group, it manifests as a spring tax bill they scramble to cover because no one told them their income structure had crossed a taxability line. The mathematics of this problem illustrate why urgency matters. A retiree receiving $2,200 per month in Social Security who selected 10% withholding sends $220 every month to the federal government. That is $2,640 per year in prepaid taxes. If that retiree's actual federal tax liability on their Social Security income is $800 annually, the overpayment is $1,840 every year. Over 5 years, that is $9,200 surrendered unnecessarily. Over 10 years, $18,400. Over 15 years, $27,600. All returned eventually through refunds, but returned late, returned without interest, and returned without any acknowledgement that it should never have been taken at the rate it was taken. Adjusting the withholding to match the actual liability, or eliminating it entirely if the liability is zero, stops the bleeding immediately, and keeps that money where it belongs, in the retiree's account, available for groceries, for prescriptions, for utilities, for life. Determining the correct withholding requires understanding the provisional income formula, which is the IRS mechanism that decides whether your Social Security is taxable at all. The widespread assumption that Social Security benefits are always taxed is incorrect and costly. Taxability depends on a specific calculation. You take your adjusted gross income from all sources other than Social Security. You add any tax-exempt interest income, such as municipal bond returns. You add exactly 50% of your total annual Social Security benefit. The sum of those three elements is your provisional income. For single filers, provisional income below $25,000 means zero federal tax on Social Security. Between $25,000 and $34,000, up to 50% of benefits may be taxable. Above $34,000, up to 85% may be taxable. For married couples filing jointly, the zero tax floor is $32,000, and the 85% ceiling begins above $44,000. The senior bonus deduction of $6,000 for single filers, or $12,000 for married couples, does not reduce provisional income because that formula runs before deductions apply. However, it does reduce taxable income afterward, which can shrink or eliminate the actual tax owed on whatever portion of your benefit the formula identified as taxable. For retirees living primarily on Social Security with modest additional income, performing this calculation with actual numbers often produces a provisional income below the taxable threshold entirely. If your number falls below $25,000 as a single filer or $32,000 as a married couple, your correct withholding is zero. Every dollar currently being withheld is a prepayment of a non-existent obligation. For retirees with pensions, traditional IRA distributions, and investment income, provisional income likely exceeds the lower threshold, but the actual tax generated may be substantially less than what is being withheld. A married couple with $28,000 in pension income, $8,000 in IRA withdrawals, and $30,000 in annual Social Security generates a provisional income of $51,000, placing them in the 85% tier. But after applying the standard deduction and the senior bonus deduction, their effective tax on Social Security may be far less than 10 or 12% of their gross benefit. Running the numbers precisely, and then matching the W-4 to reality rather than to a guess made years ago, is the difference between losing money every month and keeping it. The action step is simple and immediate. Take last year's tax return. Identify adjusted gross income minus Social Security. Add tax-exempt interest from line 2A. Add 50% of total Social Security benefits from box 5 of your SSA-1099. Compare the result to thresholds. If below, submit a new W-4V selecting 0. If above, calculate the real tax and compare it to annual withholding. The difference is the correction. Download the W-4V from the IRS website. Complete lines 1 through 4. Select the correct rate or 0 on line 6. Sign it and mail it to your local Social Security Administration office. Do not send it to the IRS. Processing takes 30 to 60 days, and the adjustment appears in your check within 1 to 2 cycles after processing. One form, one envelope. The overcharge ends. An essential caution must be stated. Reducing withholding does not eliminate a real tax obligation. If provisional income exceeds thresholds and taxes owed, that tax must be covered through an appropriately sized withholding rate or through quarterly estimated payments. The goal is precision. Match what leaves your check to what you actually owe at year end. Nothing more, nothing less. The error is not in having withholding. The error is in having withholding that was set once during a different financial life and never recalibrated to match the financial life you are living now. There is a second deduction that silently reduces Social Security checks for many retirees beyond withholding. Medicare Part B and Part D premiums are deducted directly from benefit payments each month. For retirees whose income exceeded certain levels, those premiums include an income-related monthly adjustment amount that adds a surcharge on top of the standard premium. This surcharge is based on tax data from 2 years prior. A retiree who was earning a full salary at 63 and enrolled in Medicare at 65 has premiums calculated from that working year income, even though current income may have dropped by half or more at retirement. Medicare cannot see the drop because it is referencing data that is 24 months old. The surcharge can add between $70 and $443 per month to the standard premium. The correction is a form called the SSA 44. It allows you to request a recalculation based on a qualifying life-changing event, and retirement is explicitly listed. If income fell when you retired within the past 2 years, submitting the SSA 44 with documentation of the change triggers a recalculation based on current income. Processing takes 30 to 90 days. The premium reduction applies prospectively from the processing date forward. Every month of delay is a month of overpayment that cannot be recovered after the fact. Documentation is required, typically a letter from a former employer confirming the retirement date or a final pay statement, and incomplete submissions are rejected, so gathering proof before filing avoids delays. For the retiree ready to go further and reduce the underlying tax liability on Social Security, rather than merely matching withholding to it, 2 strategies act directly on the provisional income formula. The first is Roth IRA conversion. Traditional IRA withdrawals count fully toward provisional income. Every traditional dollar withdrawn adds a dollar to the number that determines how much Social Security is taxed. Roth IRA withdrawals are excluded from adjusted gross income and excluded from provisional income entirely. Converting traditional IRA funds to a Roth during low-income years, particularly the gap between retirement and the start of Social Security or required minimum distributions, imposes a one-time tax at current low rates and permanently removes those dollars from the future provisional income calculation. Converting $150,000 over 3 years at a 12% effective rate costs approximately $18,000 in tax, but permanently reduces future annual provisional income by the withdrawal amount from that converted balance. If those withdrawals would have been $15,000 per year, provisional income drops $15,000 annually, potentially shifting Social Security from 85% taxable to 50% or from taxable to zero. The conversion cost is typically recovered through Social Security tax savings alone within 5 to 7 years. The second strategy is the qualified charitable distribution, available to retirees 70 and a half or older who contribute to charity and hold traditional IRA funds. A regular charitable deduction reduces taxable income after provisional income is set, having no impact on the provisional income number itself. A qualified charitable distribution removes the amount from gross income completely. It never appears as income. It never enters the provisional income calculation. A $10,000 qualified charitable distribution reduces adjusted gross income by $10,000, reduces provisional income by $10,000, and can shift Social Security taxation from one tier to a lower tier or from taxable to non-taxable. For a retiree in the 85% tier with $2,000 monthly in benefits, moving from 85 to 50% eliminates tax on $8,400 of Social Security income annually. At a 22% marginal rate, that equals $1,848 in yearly tax savings from one distribution alone, separate from any other charitable benefit. The principle unifying everything presented here is that the Social Security Administration, the IRS, and Medicare operate independently. None monitors your situation on your behalf. None optimizes your outcome. None alerts you when a correction is available. The Social Security Administration executes your withholding instruction without reviewing whether it still applies. The IRS processes your return without notifying the Social Security Administration that your withholding exceeds your liability. Medicare charges premiums based on outdated income until you file the form that compels a recalculation. Every one of these systems runs on autopilot until you intervene with current information and updated instructions. The W-4V, the provisional income calculation, the SSA 44, the Roth conversion, the qualified charitable distribution. These are not secrets. They are published rules available to everyone. The barrier has never been access. The barrier has been awareness, and that barrier no longer exists for you. Act on what you now understand before another month passes with money leaving your account for no valid reason. Forward this information to one person over 65 who collects Social Security: a parent, a neighbor, a sibling, a friend. Anyone who completed a W-4V years ago and never submitted a new one is almost certainly withholding the wrong amount. A single conversation could put $200 to more than $400 back in their check, starting with the very next deposit. That is their money. It belongs to them. It has been sitting in a federal account, earning nothing because nobody ever explained that the original checkbox was not permanent. The Retirement Desk Now